Well, thanks so much for tuning in to Alpha Mughals, the Diwali special. We speak to some of the finest investing minds on this show. Uh, it is amazing to have three very fine minds talking to us, but the occasion is such that it demands so. So, with us on the show today, Hiren Ved, Sunil Singhania, and Vikas Khemani to talk about their assessment of what the landscape looks like and how would they be going about their portfolio construction for their clients to create the alphas over the course of the next Samvat. Gentlemen, all of you, thank you so much for taking the time out. And at the onset, to you and your teams and your families and your clients, a very happy Diwali and a prosperous New Year. Hiren, can I start with you first? I'll go in alphabetical order. What's your sense, Hiren, about the landscape that we are in? Does it lend itself to making the new Samvat a better one than the previous one?
Yeah, I mean, I definitely think so. I think the current context is very interesting because you have a slightly challenging global macro, but what you have in India is a much stronger macro and micro in India, right? I mean, and typically that gives you a great opportunity where global investors are still trying to figure out because of what's happening at their end. But I think our markets have only been held back by the narrative that we are seeing what's happening outside with the war and energy prices and so on and so forth. But if you look at the Indian macro, I think we are very solid. We are starting a new economic growth cycle. We've already started a new earnings growth cycle after many, many years. And you haven't seen balance sheets which are as strong and as robust as we've seen. And, people forget that, in the run up to COVID, we had a pretty challenging macro with a lot of disruptions like demonetization and GST and, the real estate industry going through a tough time and then the credit markets freezing because of IL&FS. So if you survive the last 5 years, including COVID and the war, then I think the setup for the next year and the next couple of years to me looks to be very, very bright. You can't have a better context as we have today, frankly speaking, in my mind. And then you also have a large opportunity set that is opening up. I think what will be different in this market cycle versus the previous market cycle is that I think the breadth of the market is going to be far better as compared to between, let's say, 18 and 2021, when the market was very narrow at the top. I think that's likely to change, which is going to make investing over the next couple of years very, very interesting.
Interesting. Sunil, what would your thoughts be, especially in light of the fact that while India may be relatively better placed, we're still not away from the challenges. Currencies depreciated. If crude prices were to stay elevated, it impacts the CAD, and that's a clear and present danger. So how do you contextualize that immediate worry with what could happen over the long term? And I'm calling this somewhat the long term because 12 months in these days is a really long time.
Thank you, Neeraj. At the outset, please accept my heartiest wishes to you and your team and all the viewers. Have a great Diwali and a very prosperous New Year.
Thank you.
So, obviously things are challenging, but I think that is the genesis of the markets, right? Things always cannot be hunky-dory. There will always be challenges. But if you look at last summer to this summer, I think Indian markets have been more or less flat. And look what has happened between last Samvat and this Samvat. You had major issues in China. You have had the first major war, maybe post-World War of this scale, where so many countries are involved. You have had a record rise in inflation as well as interest rates. In the US, normally it takes 2 years to increase interest rate by 200 or 250 basis points. This time we have had it in 4 months. And, despite all this, we are flat. And I think that says something, right, about the greatness which this country has achieved in terms of the resilience to all kinds of macro factors and also the global factors. You did mention about the global factors, and I think they continue to be challenging. Inflation is a cause of worry. However, if you just go ahead a little bit, I think by May 23, inflation should logically come off very sharply. And it's nothing which is extraordinary, just by way of base effect. If you take, say, April, May 21 and base it at 100, April, May 22 was at 120 because of the sharp jump in all the commodity prices post the Russia-Ukraine issue. And if you just take today's prices, then, April, May 23 should be like 110 for the same index. So inflation in the US and all should come off very sharply if these commodity prices continue. The other thing is, what I know, I think the whole world knows. Information nowadays travels faster than light. And we are all grappling with the same concerns. As far as India is concerned, I think we have done very well. I think we are a domestic focused economy, and the 82% domestic economy is thriving. You have to go on the streets in this festive season. Weddings are in full force. And as Hiren said, balance sheets for corporate India has never been better. The other thing is we also have had inflation, and we have also had interest rates hike. But on a 6%, 1% interest rate hike is like 15% hike. In US, on a base of 1.25%, you have a 250 basis point hike, which is 200% from the base. So I think relatively, India definitely stands out. Having said that, if there is a 6 sigma or an 8 sigma event in the world, then India is also going to be impacted. But at this point of time, I think the likelihood of that also is pretty low. So all said and done, if the world stabilizes, India should do very, very well. At the same time, again, reiterating, I think returns expectation has to be moderate. We are not cheap. We are one of the most expensive, markets in the world on a PE basis. So we'll make returns, but we'll make reasonable returns as we move forward. On oil, our view is one of softness. In fact, we have already seen oil react to $85-90 from the peak. And OPEC is now having to cut production to maintain oil price, which I think is a positive. Because they also are seeing supply coming in and demand reducing. And if you have just been tracking a few things, rig counts in the US are at an all-time high in the last 2-3 years, up 60-70%. UK has initiated massive, development of gas fields. After 5-6 years, they're trying to do it, and they want to fast track it so that gas comes out maybe in the next 12-18 months. I think all this, initiative should ensure that supply is pretty decent. And demand has not been all that great. So, our base case is of oil also coming down further from here. And I think that also should help India.
Cross fingers, all 20 of them. Thanks for that, Sunil. Vikas, so in light of all of this, and of course, if you have a point around the global factors, one, but the follow-up question that I also have is that eventually markets are slave to earnings, and multiples, assuming that the multiples don't have room much to expand. What's your sense on how does the earnings picture shape up over the course of the next 12 months in a scenario when the world demand might be in a question mark, at least for the next 6 months, if not the whole summer?
Yeah, hi. First of all, wish you and your viewers a happy New Year, happy Diwali. I think I kind of echo the similar sentiments what Hiren and Sunil said. If you look at from last Samvat, where the environment was very, very positive, it started with that backdrop, and from this Samvat we have not we are flat. But a lot has happened in this period. Globally, markets are down 20-30%, whereas India has kind of held its stuff and still looking very, very positive. So if you see, India, according to me, is one of the most sort of promising market across the globe, beacon of hope across the globe, from a growth perspective, from a sustainability perspective. From a global perspective, I believe that by and large, we have, the expectation of inflation peaking out and interest rates peaking out there in the market. From a real data perspective, I think the next 3 months, 4 months, partly because of base effect, partly commodity prices coming out, would play out. And so I don't think, there's more shock possible or should be there on interest rate as well as inflation. So you are sitting with that kind of backdrop. And secondly, whole world when is expecting the crisis, I don't think crisis happens. Crisis always happens, so right now this sense of risk is very heightened according to me. And I'm not saying that it's unreasonable, but that's how the world is set up. But when the sense of risk is very heightened, risk generally doesn't come from, sort of my experience. But coming back to, I think, Indian macro, Indian environment, we are, I think, in a reasonably good cycle. Our domestic demand is very, very strong. Additional drivers of export-led manufacturing is looking very promising. Markets were expecting that IT demand will slow down. We have not seen that slowing down. Order wins continues to remain, which back home is a very big creator of job, right? So I mean, from Indian environment perspective, I don't see any sort of challenge happening. We are in the still middle of a earning cycle recovery. We are probably around 3.5-4% of GDP, which typically bottoms at 2% and peaks at 8%. So somewhere we are in the middle of the earnings cycle. So and also one of the interesting part about Indian market, we are very balanced in the sense it's not tilted towards only one. We are benefiting from consumption, we are benefiting from investment cycle. Capex cycle has picked up after a real long period of time. Also, currently, we don't have a very big large share in the global trade, but at the same time, our market share is growing because of China plus one. So even if the global demand were to slow down, India will not lose, but India will only tend to benefit because of the wallet share, the market share growing in the global demand. So I'm not even worried on that front because a lot of worries are there about if the global demand slows down because India is hardly a partner in that and that's only growing. So if I look at all these factors put together, balance sheet is well placed, government as well as households as well as the corporate. So you have a lot more levers for growth planned ahead of you. So in this kind of environment, markets don't tend to sort of go down too much. Every level there's a buying possibility. And another important point I do believe is that FPI flows always we have seen a massive amount of FPI flows in last sort of 12, 18 months. FPI flow starts going out from emerging market when Fed starts raising the rates, right? And typically it reverses post it peaking out. And my view is that next 3 months, 4 months, Fed rates, expectation point of view is already peaked out and actually it will peak out. And that is where emerging market flows will come back. And I do see from now to next Samvat, FPI flows returning in a big way. So you can imagine we are in a positive earning cycle, and also it is supported by the strong liquidity, both domestic as well as the international. It could create a very interesting scenario from now to next summer, and that's what I would bet on.
Maybe broadening of the market, because as Sunil said, I mean, there is only as much room that we have on the valuation front. So I don't know if that means that the cycle broadens up. So Sunil, let me start this cycle of questions with you. What's your sense around what's your portfolio strategy, keeping in mind all the factors that the three of you just spoken about? How are you placed? I'm not saying you place your portfolios for 12 months, maybe you place it for longer, but just keeping the Samvat in mind, how are your portfolios positioned?
No, I think last, frankly, 6-9 months have been tough as far as managing money is concerned. I'm very sure it is true for even professional investors and other funds, because movement in the market has been very sharp and very brisk. Sector rotation has been very sharp, largely because the short-term news flows have dominated the market movements more than taking a call from a 2-3 years perspective. However, we have always been very clear that market returns are all about earnings, and therefore our portfolio has always been focused on companies where there are earnings, where there are visible growth in earnings, and what we pay today will be more than made up by way of future profitability. And I think that is what we stick with. Having said that, I think the next couple of quarters are going to be tricky for a few sectors. The full impact of higher commodity prices, at least for a few sectors, will be felt in the September quarter, because post Russia and Ukraine issue, the price rise happened in April, May, June, but that quarter quite a few companies had old inventory, so they did not get impacted. I think this quarter you have had the major impact of raw material prices move up and then also move down, so there would be some inventory losses also for a few companies. So I think this quarter is going to be a little bit tricky, but it would be more than made up because the next couple of quarters, because of the whole tailwind following the great festive and wedding season which we are seeing going forward. So I think we continue to focus on sectors and companies where there is visible profit growth from a 3-4 years perspective. And I think that would be the stance as far as our portfolio is concerned. Obviously, sectors are always there. We follow a very balanced strategy. We are not looking at something from a 3-6 months perspective, and therefore, our view on financials, our view on IT, pharma continues to be as strong as ever. A little bit of tilt more towards the domestic side of the portfolio, so maybe companies which will benefit from the huge capex boom which we are seeing from the huge, I would say, the growth on the consumption side, particularly the tier 2, tier 3 cities, a little bit of tilt there. And I think at the margin, we are tracking at least steel sector a little bit more closely, though we don't go too overboard there. But our view is that if the world has to stabilize, there is going to be fresh liquidity surge. China is opening up. I think China also needs to grow. And we have heard what the Chinese premium had to say over the last few days. So that is one, I would say, the dark horse which we should, keep a track on.
That's interesting. Because can I bring you in? Sunil made this important point about how, while the long-term focus on portfolios stay, there is a bit of a tilt towards the domestic focus themes. Would that be something that you would be doing for your client portfolios as well? How are you, or what is the bent of the portfolio towards for the next 12?
So I think we are reasonably well, focused on right now. We think we are in a reasonably good uptick of a banking and financial growth trajectory. So we are significantly overweight in banking. We think credit and banking per se will do very well over next 2-3 years. Likewise, I think automobile, we've just begun after 5 years bit of a growth journey post ILFS pandemic and chip shortage crisis. So numbers are just beginning to grow, and we think this can play out and partly consumption on that as well. We are also reasonably well placed on the exports market, which is by betting on manufacturing-led growth, where market share is shifting away from China, and also this kind of portfolio provides you a bit of a stability in this kind of global uncertain environment where the currency helps you. So, and of course, there's a bit of consumption as well, but we would say that broadly these 3-4 sectors, we form large part of it. And lastly, I think capital goods, we have a heavy weight. We think that investment cycle is here to stay for a long period of time. So that's one segment doing very well. So in that sense, across these 4-5 sectors, we have reasonably well balanced portfolio, and which we think will outperform over next 3-4 years in a reasonably good way.
Sunil mentioned IT because you've been a proponent of that. You continue with that position stance on IT as well.
Absolutely. I think we had cut down a bit of IT earlier part of this year, and now I think we are equal weight, and we will be waiting for 1 or 2 quarters to go overweight on that. We think that IT pessimism is overdone. You will begin. Biggest barometer is the order book of the company. You see order wins have been very, very strong, and that will have, if somebody is giving you a large order, when they are also able to see that the US might go into recession. So CEO of company knows very well, and he's still giving order, contract. It means that this is more of a non-discretionary kind of nature of demand, and hence you will see IT sector continue to remain robust. Now, whether it will be 15% growth or 12% growth, that will depend on the quarter to quarter, year to year. But generally, it's a very solid sector to bet on.
Hiren, I think about 2-3 quarters ago or 4 quarters ago, maybe slightly before that, you spoke about this manufacturing renaissance, which leads me to believe that your bent as well would be more towards the domestic focused space on the portfolio. Am I mistaken here? Can you talk a bit about it?
Yeah, see, you always see broad themes. I think, we all have bets across sectors, and typically you don't tend to change your bets like how the narrative in the market changes. But yes, I think if you were to ask me what's the 1 or 2 big defining things that will change over the next couple of years, and where we've kind of infused those ideas in our portfolio, I do genuinely believe that we had a lost decade of manufacturing going post the global financial crisis right in the run up to COVID. And that is likely to change for several reasons. 2 or 3 of that is that there are at least 2 or 3 very large sectors globally which are changing, right? One is that there is a massive energy transition which is likely to happen globally, from old fossil fuels to renewable energy, and there could be a interim period because of the challenge of the Russia-Ukraine war where some countries are going back to coal, which is understandable. But if you look at the broad direction, the very fact that very large groups in India have announced large capex plans towards cleaner energy tells you that that's where the world is moving to. And it's not just India, it's a global shift. And whenever such large global shifts happen, it creates an ecosystem of a lot of companies that participate in the value chain, right? So there are opportunities in manufacturing that will come through. The second change at a global scale is the electrification of the transportation industry, where we are moving from fossil fuels to hybrid and electrification, right? That is happening. And then there are 2 or 3 other very domestic focused trends that we are seeing. A lot of it we have talked about. One is that defense manufacturing is now becoming a reality in this country. Second is that many Indian companies across sectors are becoming part of the global supply chain because of the challenges that we see, whether you call it China plus one, Europe plus one, right? And third is that electronic manufacturing in India is likely to boom, right? Because we now have to start manufacturing a lot of the stuff, as you know, that India now from being a net importer is a net exporter of mobile phones, right? But it's going to happen across the value chain. And 2 other large groups in this country have also realized that you need to start manufacturing semiconductors if you want to become leaders in the next technology revolution, right? So I think with so much of change across these few large sectors is likely to reinvigorate the manufacturing sector in India, whether for domestic import substitution, Atmanirbhar, PLI, or whether for exports as part of the global supply chain. I think finally, after many, many years, I think that you are going to see a huge renaissance in manufacturing in this country. And therefore, we have across the chain, right? I mean, because there are very interesting opportunities, whether you buy an auto company or an auto ancillary. And today, auto ancillaries are not just servicing auto components. They're also doing stuff for renewable energy, and they're also plugging into the EV supply chain. And some of them are also doing stuff for defense and space. So there is an opportunity, in my view, in manufacturing, which needs to be captured. And I think that we are adequately positioned, apart from the fact that we are also very excited about the fact that consumption in India is likely to grow manyfold as India crosses the $1,800, $2,000 per capita income, which is likely to uh, see a hockey stick over the next few years in several consumer end industries. It could be housing, it could be entertainment, it could be luxury goods, it could be cars, SUVs, right? You name it. So I think there is a big shift in manufacturing and there is a big surge in discretionary consumption coming in this country. And we are well poised to take advantage of that.
Okay. Jamin, a final round of questions before we wrap up. And because I'll start this round with you. Something which was a long thought of theme until the last Samvat suddenly is just vanished from everybody's mentions, if not portfolios. What is your view on specialty chemicals? It's kind of had a long road until now. It's just kind of fallen off the radar. What's happening here?
So I think last post-pandemic, it's got on the fancy, and there was a pent-up demand partly because of the supply chain constraints. So companies saw accelerated growth, and most of the capacity was utilized. If you see, chemicals and specialty chemicals, and for that matter, in any manufacturing, you need capex to have the further round of growth. So I think in specialty chemical, 2 things have happened. One is that most of the companies have had slow down the demand because of the or turnover because of the pile up of the inventory at the customer level and softening of the prices. And secondly, I think most companies are going on a massive capex program. So capex will go next 1 or 2 years. So you might see a period of consolidation in the field. I mean, companies are going through 3x, 4x, 5x of their historical gross capital. So whenever companies go through this, equity shareholders don't tend to do well because your EV expands and EBITDA remains same. So I think these 2 issues hit the sector at the same time. But having said that, the structural drivers of the growth remains, and if you overlooks, and it might remain so for next 6 to 12 months, because as the inventory clears up and capex will start going live in most of the companies' cases only post 23, March 23, so next year. So probably this year it still will remain out of flavor, and as earnings starts coming back, as price starts firming, as margin stability comes, you will see this sector again coming back into favor. So, and every sector goes through this like let's say IT is a structural thing and it went through a period of correction and it will come back. So every sector which goes through this kind of phases where a bit of a euphoria gets built, everybody thinks that this is here to sustain, and then you see a bit of a correction. So I would say this is a passing phase of a year and a half or two in this sector, but it is here to stay.
Okay. Hiren, you mentioned defense. It was also one of the most sought after conversations at a summit that we did recently. The refrain that I get from people who are not completely excited about defense is that it still remains a single buyer space, and there could be receivable issues going ahead into the future, if not now. And export, while is a good thing to talk about, we haven't seen telltale evidence of Indian defense exports becoming a reality. How would you think through all of these three concerns for defense?
No, I think it's not a cakewalk for sure, right? And the fact of the matter is that there is a single buyer. But I think the way to play this is, I think not to get, as I said, not to get too excited about any narrative. I think, as I mentioned, in the total manufacturing opportunity set, defense is definitely going to be one of the areas that is likely to be a real opportunity, right? And we are today seeing that. If you look at the order books of some of the defense PSUs, whether in shipbuilding, whether in aircraft, whether in ammunitions, I think it's becoming a reality. And as I said, that in India, the interesting part is that you can bet on high quality engineering companies or auto components or capital goods company which straddle 3 or 4 opportunities. So defense is probably one of the growth vectors. It's not necessarily the only growth vector, right? Because yes, there are challenges because there is a as you know, in India today, a lot of the defense spending is actually revenue spending, and the capex spending is not very significant. So it's going to take, it's a very long-term theme, right? So let's not get very excited. But I think the way to play this is to play it through a bunch of auto components and capital goods and engineering companies, which also supply a part of it into the defense revenue stream, right? But I think it's a reality for sure now. I think the time has come. And given the geopolitics that we are seeing around us, I don't think that we can now afford to keep importing defense equipment in India.
Got it. Sunil, the final question on the show to you. Lest it sound like I'm making it a IT dominated show, but I'm still inclined to ask this to you because it's a space that is kind of at the back burner currently. But when I talk to managements, they all talk about how the wallet share seems to be increasing and how in a lot of conversations that they are having with clients, they are almost becoming non-discretionary in nature. Two questions before we wrap this up, Sunil. One is, do changing valuation multiple parameters around the world for markets at large and therefore for sectors impede the kind of valuations that the sector will enjoy compared to what it has enjoyed in 2020 and 21? And part two, could there be a period of lull before earnings growth picks up again? Or do you think this time around the playbook for IT companies will be different than the previous times wherein the world has entered into a bit of a slowdown or recessionary phase?
So first of all, Neeraj, IT is a very broad kind of a term. I think in India, we have IT services company. Globally, IT also means all these new age companies. And I think what we saw globally is a lot of these new age companies go through the roof earlier and then fall 70, 80, 90%. And I think Indian IT services companies also suffered to some extent because of that, because, generally IT is everything which has got to do with IT, right? The other thing is you have had waves of, under optimism and over optimism. So we started the period pre-COVID where valuations were very reasonable. And then you had COVID where your obviously profits went up higher than expected and the valuations also went up significantly higher than earlier. And therefore you had stocks multiply 3, 4, 5x, particularly on the smaller cap side. And then you had a realization that, yes, the normal growth is X, not what was being done by the company in 20 and 21. And therefore, the valuations also to some extent corrected. And then when correction happens, they always correct a little bit more. If you see the banking space, for example, I think May and June were the worst months for banking. And from there, even the large caps have moved up 50%, and some of the smaller banking companies have, in fact, doubled. It's not that fundamentals have changed. It is the perception or the way the investors have started looking at it has changed. So a lot of times, market price is equal to EPS into PE. EPS is the earning, PE is perception. And market price change are more because of the perception change than PE. PE will be changing 5-10% more up and down depending on your expectations and what the companies actually declare. But perception keeps on changing. I think IT services as a sector, as far as India is concerned, India has global competitiveness. This is one sector where India is globally competitive. The currency, particularly dollar, is a tailwind. Yes, there might be a little bit of slowdown in volume terms, but that would be more than compensated by one, less pressure on the margins because the headwinds of costs have now receded. And second, you have tailwind as far as currency is also concerned. So, if you're content with 15% profit growth for the next 3, 4, 5 years, I think it's a great sector. And if you start to have that kind of visibility, it is also possible that the PE might expand a little bit more. And this is one sector where almost 80-90% of what the company makes is distributed. No other sector does that. And we forget that, even if the stock price goes up 10%, these companies have a 4-5% yield in terms of dividends and buybacks. So ultimately, you end up making 15% plus, which is not bad. So I think we continue to be quite optimistic there.
Great. Okay. So as we wrap up, last one answer each from each of you, a health resolution or an investment resolution for the new Samvat. Sunil, I'll start with you.
And I think health, we have all realized, and, we have so many near and dear ones who have unfortunately, not been a part this year because of whatever has happened. And we have also seen what, health issues with, despite all the wealth you have can create. So health has always been a key focus. And I think to the best of what one can do, I think we'll continue to do. Peace of mind is very necessary. There is this great saying in page 3 that, dost fail hota to dukh hota hai, dost first aata to bahut dukh hota hai. And I think we all end up in life running because of peer pressure and because of relative wealth. I think that is very difficult to overcome, but I think at least, I have taken a resolution that, be happy with what you have. Kaam karte raho, kaam mein kami mat aane do. But, there has to be a limit to what you run after.
Thanks for that, Sunil. Vikas, health or wealth, one resolution for the new Samvat. I mean whichever one. I'm not asking you to choose, but I'm asking you to tell us about one resolution.
No, so I think we've spoken many times about it. I am on my spiritual journey, so I've been doing, and I just hope that I can continue to do 3 days of yoga, 3 days of vipassana, and 1 day of running. So that is as far as the health is concerned. I think I just feel that in our life sometimes you end up compromising and not follow consistently. But I kind of so far I've been following, and I just hope that I continue to do that because it allows, like Sunil was saying, to have the balance of mind and peace of mind. There's always a lot you can do, but you have to be happy and content with what you have. And as far as the investment is concerned, I think I remain very, very, very bullish on India. And a lot of times, the kind of clutter, noise which just comes around, it just tends to at times impact you. So I just want to, stay away from all the noise, and constant effort is to stay away from noise and just stay to the focused on your objective and don't worry about the outcome. So that's what I would say.
Okay. Well, I know that maybe this year I will see Vikas and Hiren both at the Mumbai Marathon. Sunil, hopefully we'll get to see you as well in some time.
I will run in my dream. So I will do the dream running in my dream.
That's good. Well, Hiren, let's wrap up with you. Last piece on the show, a health or a wealth resolution, either one.
No, both actually. I mean, I think COVID made everybody realize the premium on health, right? I mean, I think it was COVID put a big cost if you were unfit. I think health hai to sab kuch hai. So As you know, I keep myself healthy by doing a combination of running and yoga and a little bit of weight training. I'm planning to add swimming to the equation this year, hoping to do that much more religiously than I used to do earlier. And I think as far as wealth is concerned, it's a byproduct. I think for us, investing and creating wealth is a passion. The concomitant wealth that comes through is a byproduct, and don't be too anxious to try and achieve something because it doesn't work. वो जब आना होता है तब आता है. You have to just keep doing the right things, and eventually it will happen. You can't time it, you can't browbeat it, you can't extend it, you can't prepone it. Wealth has its own journey, and that journey is cannot be tampered with. You just keep doing what you're doing, and the markets and situations will give you enough opportunity. So when the right opportunity comes, you should be awake and alert, and that's when you can make the best out of it. But otherwise, the least activity, the least noise, the better it is for wealth creation.
All right. Stay awake, cut the clutter, and stop thinking about relative wealth. Amazing resolutions, all of you. Thank you so much for joining us today on this very special show. Much appreciate your time.
Thank you.
Thank you, and wish everybody a happy Diwali, a very prosperous new year, and a healthy year ahead.
Indeed. Viewers, thanks for tuning in.